Hi everyone, John here from Tribox Private Wealth. I recently had the chance to sit down with a good friend of mine, Samir. He's the president of the healthcare division of Viper Equity Partners. Samir's got over 20 years of experience in the healthcare private equity space, holding leadership roles at organizations like ChenMed, Cancer Treatment Centers of America, Sage Dental, and South Florida Radiation Oncology. In our conversation, Samir shared some very powerful insights on how strategic business planning, private equity partnerships, and healthcare transactions are shaping the future. I think you'll find this perspective both timely and valuable, and doesn't really matter the industry you're in. This is a sneak peek into private equity and how it might help you as a business owner. So I hope you enjoy. All right, well, welcome to episode number 2. I've got my friend here, Samir, who has experience in private equity. And Samir, this channel is all about helping business owners beyond just the financial planning and stuff that I can do for them. I wanted to be able to educate them on just different things that they deal with in business. And I've known you for a long time. You're a good buddy of mine, and you've played in the PE space, the private equity space. It's kind of an elusive, people don't understand what it is, when they would consider using it. So I wanted to bring you on and kind of help demystify PE private equity. And so thank you for being here and welcome.
No, thanks for having me. Yes, it's a black box. People look at, they don't know what's behind the curtain, when the show starts, what happens, and do I want to be part of the dance or not? So happy to provide more insight and transparency. We've been doing it a long time, and private equity's presence is just increasing in a variety of industries. So I think it's a great topic to cover for business owners.
So before we get into some of the questions, just give us a little background of how you got involved in it and what's changed. I mean, you've been in it for quite a while now, so kind of what's changed and what is it? Like 101, what is PE, private equity?
Absolutely. So I would say, starting at the top, what is private equity? So private equity are dollars that are, people have heard of pension funds, they've heard of endowments, they've heard, all these places that get money. Well, if you're part of the Ontario Teachers Pension Union or Palm Beach County Government Employees Association, all that money that's going into a pension plan is going and being put for the employees' benefits. It's being managed, but then those endowments and pension groups are then taking those funds and distributing them across different areas, such as the stock market. They're putting it up for distribution in bonds, which are the commonly known investments. Mm-hmm. They do real estate. The other most uncommon known is these private equity vehicles. And these are where funds are committed for a period of 5 to 10 years. And these businesses take these funds and invest in other businesses and look to provide a much higher return to the funding source than would typically be achieved in the stock market or capital markets. You're talking about returns that are looking like in excess of 25, 50, 100, 500% returns we're talking. So it's a capital sliver that's sort of taken from these groups. So that's
when you hear the number, 25, 500%, the first thing that red flag that goes up, like, oh, that's got to be extremely risky. That's got to be way too much risk. There might be some people out there that are invested in some of those pensions. Maybe they were a government employee before they started their own business, that there might be sleeves in there that are contributing to the returns they might have seen, and they really have no idea in terms of like that much is helping their overall return inside of those assets. You're
exactly right. I think people just look at the number on their return, but they don't know how the return actually came. Mm-hmm. So this is every group manages it differently, but I think, gaining wealth by owning a business is one way to see you can see how the returns are much higher than working for somebody, right? So I think, and if anybody knows, a business owner knows, having your business and then being able to sell, if you were to actually do the math, is substantially higher than being a W-2 employee for 20, 30 years, essentially, right? So these groups are investing that money. How I got started was I worked, for big healthcare companies. And in the PE space, when it starts, you're going to hear terms such as private equity, and then you're going to hear groups that are called strategic groups. And so I worked for the groups that are called the strategics. And what that means is, hey, I am an operator in this space, and I worked in the oncology space, I worked in the primary care space, and these are companies that were started by entrepreneurs who are privately funded, not backed by PE, and who are looking to acquire or bring in other growth channels through acquisition. And so what you'll see is you'll have a sliver of these strategic groups in the mix, and then you'll have these private equity groups that are in the mix. And essentially their goal is to become a strategic buyer over time. And so what they will do is they'll look at an industry and say, what are the attributes of the industry, right? And a simple example, we can say, okay, let's look at the car wash business. And in the car wash business, is it a fragmented business? Is it many owners? Is there a way we can come in and add synergies by centralizing a lot of the services that are provided and providing that same services over a scale, over 100, 200 units, right? So private equity saying is, okay, if a business is doing $1 million in revenue, can we get, and the margin, say their profit margin is 20%, can we get that profit margin to 40% if we were to do it together and made it part of a larger group, right? So private equity is looking at all industries across the American economy.
Probably storage facilities are probably, ripe for that, right? Because you've got the mom and pops who originally started them, and then you've got the big boxes that came in and bought them. So that, as I think about that, right, because then you can, economies of scale, right? You've got 5 or 6 different locations, driving distance. You can put in the same software, eliminate a lot of, maybe have one manager that goes and checks out all locations. So looking at it from how you can take a business and systematize it.
Yes. That's exactly what they're doing. Because, I think mom and pop entrepreneurs, that's the bread and butter of the American economy. It's fantastic. But there comes a point where they reach or have exhausted their level of sophistication. They can't take it to sort of the next level, right? Every entrepreneur hits that as part of you just look at sort of the business life cycle, you hit a peak, and you're like, well, gosh, I can't get above this hump here. And so that's where private equity comes in, is if you've done an incredible business, you've made, gross revenues 25, 50 million, whatever it is, how do you take it to 200 million? And that's where those set of tools, access to capital, sophistication with private equity can really come in, because mom and pops do a great job, but the vast majority of them are family run, and they can only take it so far.
So what's the difference between private equity and private funding?
That's a great question. So private equity is a group of people who have come in that are actually putting equity into the business, and then they're going out and getting a loan to finance the rest of the acquisition. So meaning they've actually put capital of their capital into the business, versus private funding, it's really somebody just giving you a loan that they align with you, but they don't really have skin in the game, right? So to the extent that they've taken other capital, there's different arguments made. But I think when you look at private equity, is they've come in, put their own equity in there from their fund. They also then have a network of people, typically in a private equity fund. Let's say they raise $100 million. They have business advisors that they have as part of their network that they can rely upon to help you grow the business.
Whereas private lending might be, you might give me a loan for $1 million to help me scale, and you might take a piece of it, but that's about it. I just let you borrow the capital. Where private equity is, not only do I get the capital infusion, I also get the team of experts that can really help me with those roadblocks. Maybe it was in the marketing, maybe it was in the managing of people, maybe it was in production of the widget.
Yep.
They bring their whole team in, really, to basically, team comes in and becomes part of your team.
Absolutely. And it's really, what we've heard a lot with private equity the last sort of several years is, we want to come partner with you. We don't want to come in and command and control your business. We don't want to change the name of the business unless they tell you that up front. It's more of, hey, how can we collaborate to remove one administrative burden, any administrative roadblocks that are preventing you from scaling, and really just unleash you to be the best business person you can be, right? So how does that group come in and do that? And to your point, you nailed it. There's the revenue bucket. How do we help you increase your revenue? There's a cost bucket. How do we lower your costs and take away you dealing with administrative? Let's say you have 100 employees. Nobody wants to deal with 100 employees. How do you have an HR system, right? So they really want to come in and say, free up the business owner and proprietor to take it to the next level. And I'll add one more caveat is they want you to stick around. They want you to be a business owner who's going to stay in the business for the next 3 to 5 years and align with them and have stock in the future company so that you can go, right? A private funding group may give the business a loan, but they don't really care about succession planning or what that looks like potentially unless they actually put in the document. So I think that's a very different thing because they've really tied in what has been the success of the business.
What's control look like, right? So, I'm the owner of the firm. I've been running it for 28 years, and all of a sudden I decided to bring in private equity to help scale to the next new level. This money comes in, we close the deal. What does control, day-to-day control and the leadership direction look like?
That's a great question. I think this is where when you decide to go talk to private equity, having an advisor talk to you about what a deal looks like. And this is a very important point to bring up early on in the discussion. Because if they want to come in and control the business or have any intentions of bringing on a CEO, that should be said to you up front, right? So that you know. But typically what they'll do is they'll have a board governance, and they'll have board seats. Let's say there's 5 people. They may have 2 seats. There may be another. You may have 2 seats. And then they may have, another advisor. But then there's board control provisions. So there's a lot of control that's had at the board level. But in the day-to-day administrative, if you're going to continue as the CEO, they're going to leave you in that capacity and leave your management team if you're happy. If you need a deeper bench, or you need to hire a CFO, or you need to bring on an accounting person or a specialist in marketing, VP of marketing, they'll help you do that. So it really just depends on who the buyer is and what your goals are as a business owner, right? Because some people just want to transition out.
Right. So in essence, it kind of functions like a hybrid publicly traded company without the red tape, because you get the board of directors, so to speak. They're helping set the strategic direction. You have input and you're like, hey, I want to go this way, and they're ensuring that the alignment is right for them given their expertise, right? Because I couldn't scale the business where I wanted to. That's why I brought them in, right? So they're kind of like, hey, yes, that makes sense, but this doesn't make sense. Here's the reasons why. And collectively, you might set the vision, but then day to day, you're still responsible for the day-to-day interactions of what's happening.
That is exactly correct. Okay. And I think what they also do a good job of is they start systematizing your business, right? Because most mom and pop or business owners are really not accountable to anybody. Versus when you have a partner, now they have to set up a budgeting process. What's our goal? What's our forecast? Mm-hmm. Where do we want to be in 6 months? What's the ROI in this investment? So they start asking questions that may feel intrusive, but they're really collaborative if you think about it. It's like, well, I probably should have thought about like marketing. If we're going to spend $200,000 on marketing in this new campaign, was it the best? What's their resources? Did we thoroughly vet the opportunity, right? So I think that's where they become helpful. And you still have access to the accounting and the system, so you can see everything. It's they really want to make it so you're making the most money possible.
How long does someone usually stay on? So when they start working to scale a company, is it usually the last 3 to 5 years or 10 years, or are you seeing younger people come in who want to be more aggressive? Like what's the demographics of the type of person who is considering PE?
So I think that's a very important topic. I believe the best sweet spot to get into, have discussion with PE, is anywhere between the age of 45 to 55.
Okay.
And the reason I mention that is because if you're going to do a deal with private equity, a lot of times they're going to want you to stick around and have stock in the company. And that stock is called rollover equity. And so as they continue to grow that business and you have stock in the business, that stock is going to become very valuable. So let's just use some examples. I think it's important to understand just deal structures. Let's just say the value of a business is 10 million.
Okay.
They're going to, and they say, okay, we value your business at 10 million. We're going to do 70% cash and 30% equity. So they're going to give you $7 million of cash upon the deal closing, and then you're going to get $3 million of stock in the company so that you're aligned with growing the company in the future. And then the private equity group is also
Is it usually that rich, 70-30?
Usually that's the typical private equity. So you're going to get anywhere between 65 to 80% cash at closing, because most groups like majority control at the remaining portion they're going to want to align it via stock. Now, why that ties to your question is because as the business valuation is 10 million, they're going to say, how do we get it to 100 million over the next 5 years, and what do we need to do? And so they're going to do a variety of different things, growth incentives, etc., to grow the business. So you're going to have $3 million of stock. When are you able to cash that out? And that typically can take anywhere between 5 to 10 years. So as the business now is worth 25 million in gross revenues or whatever it may be doing, your stock is also going to increase by a factor of 2 to 4 times. So that stock, what we refer to in the business, is called the second bite at the apple. Right. So you get your first bite with the cash, then you get your second bite with the stock. So that's why we say 45 to 55, because that's a good period to work for another 5 to 10 years to liquidate that stock and truly get out not only your cash from the business, but the stock.
So in essence, you get to true up, when you do the deal, pull some money out of the business, which business owners are notorious at not doing.
Correct.
And then you still get skin in the game that says, hey, as we grow this thing, you're going to benefit on the back end when you have a final exit.
That is exactly it.
One thing I want to bring to light is that some people might be listening to this and they're like, "What's he talking about? I'm going to go from 10 million to 100 million, right?" That's like somebody tuning out. But I think the business owner really has to think about how undervalued the business might be. Not so much undervalued, but you're not tapping the full potential of the value because you don't have a lot of these systems in place, that are reducing the amount of overhead with increasing your profit, right? So there could be a very large unlocked potential in the business within the first couple of years just by optimizing it.
Absolutely. And I have this conversation with business owners. I said, if you're a business owner, can you think of your top 5 competitors in your state? And what if you could buy them out? How much would your business be worth today? And then that gets the wheels turning, right? So if you think about, gosh, who are my competitors? Well, can this business really be worth 100 million? Absolutely. It's if we are able to reduce duplicative expenses, create synergies in our expenses and our profit and loss, and really combine our growth trajectory and revenues, it's very easy to do. And that's what the private equity playbook has. They've sort of created this playbook says, we know how to focus on the different buckets. We know how to focus on the revenue bucket. We know how to focus on the cost bucket. And then we know how to focus on the acquisition bucket, which juices the revenue. Right? So if you're having those three.
It's not just their business, right? And
Correct.
that's what they have to understand is like
Right.
that 30% that they're getting stock in, that's 30% of the overall pool of
Correct.
other, companies that are very similar. Well, not very. They are similar, right? I mean, if you're dealing with dentists, it's dentists. You're not going to mix a plastic surgeon with a dentist,
Correct.
right? So all those dental practices collectively, as they keep bolting them on, that's going to add to the increased value of their portion of that stock.
100%. And you just think about if we use the term EBITDA, right? So if you have 5 million in EBITDA and you buy a bunch of new other practices that have another 5 million in EBITDA, let's just say you buy another 5 that are similar in size, that's 25 million in EBITDA that can really scale a business quickly and be ready for a secondary sale, right? So it's not that much work to actually put it together. Yes, there's integrations a lot, but to actually identify the groups and pull it together, it's really not that hard. And these groups, the private equity groups that you're dealing with, likely have done it before in a variety of other verticals. So I think
it's probably one of the things you want to look for, right? So if I'm vetting out a PE firm, right, I probably want to look at the track record of that they may have with my type of company, right?
Absolutely. That's exactly what you want to do. So one, as you think about going to market, having an advisor talking to the right private equity groups is critically important, right? Because I've heard this happen where business owners have gone down the process themselves and just had supposed private equity guys reach out only to not be able to secure funding. So I think it's important that there's a lot of people that represent themselves as private equity, but really understanding how much funds have you raised, what's in your, how well capitalized you are as a business, have you done this before, are very important questions to ask.
Are there any, like in my industry, you can pull up any advisor out there, right? Mm-hmm. and get information on there. Is there any resources that someone could turn to kind of vet out a PE firm?
I would say speaking to a investment banker is an important way to do it. Certainly you can go online and vet out the private equity groups, but there are thousands of private equity. It's very hard to vet out 1,000 private equity groups, right?
So there's a lot of them.
So having an investment banker or a business broker who's done transactions in your sector can really help get a deal done quickly, right? So I think if you are in the car wash industry, there's guys who are doing deals in car washes and they know who's real and who's not real. And then so if you ask me, we work in the healthcare space. We know who's real, who's got deals, who's a good player, and who are the tire kickers, right? Because there are some private equity groups that are notorious for just tire kicking. And they'll ask for a bunch of information and will never make an offer. So I think it's a very complex.
They're gun shy. They want to get in the space.
Yeah, they want to get in the space, and they're just trying to get information. So I think it's important about having non-disclosures in place, making sure you're going about it the right way, and before you even begin a conversation with private equity, the most important thing I always tell business owners: have your house in order, right? Just like you would be listing your house. You want to clean up your house before you do any showings or any listings or any pictures.
So what would that look like for someone who's considering PE?
Yeah, I would say, the things you want to accomplish as it relates to making sure your house is in order. One, are your books in order? Financials, that's going to be critical. Do you have a solid accounting system in place? Do you have are your expenses clean? Do you know what, if you're running personal expenses through the business, what does that look like? Mm-hmm. Can you identify those? Because there's going to be a third party that's going to come in and vet your business once a offer is submitted and you accept that offer, right? So there's a whole due diligence process. So
that doesn't happen until after I accept it. So I don't have to worry about like, hey, I want to have a conversation, but I don't want you digging through all my stuff.
That is correct. But they're going to ask for basic financials, right? So I think having basic financials in order for the last 3 years is critical. I think having your practice management, records management, whatever system you use that you record a lot of your transactions, clean and in place. I think having your bank system, all those things clean, and really segregating your personal expenses from your business expenses are going to be crucial, right? They're going to want to pressure test, hey, if this guy's making 10 million as a business owner, is he really doing 10 million? Is there potential fraud or money laundering that's happening, right? So I think to the extent that can be done and working with the appropriate advisor, they should be doing that pressure testing in advance.
So you mentioned advisor, a couple times. Like, who would that? So two things. Number one, what is the dollar amount I'm doing, whether it's an EBITDA or top line revenue that I would begin to consider? Mm-hmm. And then number two, as I'm going through my books and cleaning house up before I make a call to a guy like you, who would be the advisor that I'm searching for?
Great question. I would say to answer your question about revenue and EBITDA, I said, listen, as soon as your business goes over $1 million in revenue and you have about 250,000 in EBITDA, you should start thinking about, do you want to hire an advisor? And then advisor could be an investment banker like us, right? There's people that work in different slivers. Mm-hmm. Some people require certain revenues and certain EBITDAs, but I think those are sort of the gating items, right? I would say million in revenue, 250 in EBITDA, and once you pass the age of 45, you should start having those conversations. Because you may not initiate that relationship right now. You may say, I need to grow, right? And have that conversation and start making sure things are organized is what I would say.
Does a company like yours, does it work with someone who may want to hire you as an advisor first for a few years and then step into it? Is there's programs that or services that kind of graduate someone through that, or when they engage with a PE firm, it's like, hey, you engage with us when you're ready, pull the trigger.
Yeah, we actually work with, that's a common question amongst a lot of business owners that we speak to that are sort of still building. And so we work with a number of consultant groups that we can refer them to. Our firm specifically only does the transaction part of the business.
Okay.
But being in the industry, I get common questions. Hey, do you know consultants who can help me on this part or that part? And the answer is absolutely. So we can get you connected with those people. You work with them for a year or 2 years to fine tune the business. And then you come to us once you're ready to go to market. That's sort of what we do. And we have no problem having those conversations. It doesn't cost you to have a conversation. Right. And for groups like us, we work on a contingency basis. So you're going to have, your success is our success. So there's no real cost to do business with us.
So, I mean, I guess helping them, right, always helps you down the road, because if you help 10, 15 people over a 5-year period, one of them may come back and be like, sure, hey, I work with this consultant, I'm ready to rock and roll now, right? So it's just that spreading goodwill. What about the tax implications of that in your example of the $7 million cash up front? How does that get reported, to the business owner?
Yeah, that's a great question. So, I'll start at the 10 million because this is an important nuance to know. So when you get that valuation for 10 million, people start counting the dollars in their head. How much am I going to pay on taxes, right? Mm-hmm. So people do the simple math. Gosh, 10 million.
30%.
Yeah, 30%. I'm going to pay 3 million in taxes. Well, the answer is, good news is you're not going to pay 3 million in taxes. That's because there's a tax code. What these private equity groups do when they split the valuation to get $7 million in cash. Yes, you're going to pay $7 million on that. $7 million is going to be taxed, and I'll come back to that in a second. That $3 million in stock is going to be deferred in taxes till you have your second bite at the apple, because what that's going to do is it's called rollover equity, because you're going to take that equity and you're going to contribute it to the new business. And in the IRS's eyes, that is considered a tax-deferred event. Okay. So you don't pay $3 million on that taxes on that $3 million today. You only pay upon a liquidity event, which can be 5 or 7 years. So one, that's a great tax savings, right? I forget the exact code. I think it's like a 721 election that they do. Mm-hmm. But that $7 million in taxes, you typically are taxed at long-term capital gains.
Okay.
And that is at 20 to 25%.
So there's a basis established on what that would be, and so some of it would be basis, some would be long-term capital gains.
That is correct. Now, people have to remember there's a little fine nuance, so it's important when you talk to your tax advisor, try to get, of that $7 million, they're going to bifurcate that $7 million in taxes. They're going to say, okay, great, not all of it can be good, capital gains, because you're going to have equipment, machinery, etc. So they're going to bifurcate and say, okay, if it was a doctor for sale, there's personal goodwill that's going to be attributed. So you want the goodwill to be as high as possible. So let's say it's 80% of that $7 million. So 80% of that $7 million will be taxed at capital gains. The remaining portion will be taxed at ordinary income.
So I think the point is that for the listener is that 10 million, it seems like a big number. Don't stress about, being taxed at 30%. there again, having the right advisors on your team, right, can help mitigate that. And the reality is you'd probably be paying long-term capital gains on maybe a number. Whatever,
Yeah.
4 million, 3 million, whatever.
Exactly. And I think, another question people often ask me when this conversation happens is, what if I don't sell? I can just work another 3, 4, 5 years and make that money. I said, you certainly can. But what business owners sometimes forget is if you were to get a $10 million valuation and you pay the vast majority of that $10 million in capital gains, let's say you pay $2 million, 2.5, right? Versus if you made $2 million a year, you're paying federal taxes. Your tax basis would be much higher over 5 years if you did the math, if you just actually paid federal taxes versus took a liquidity event. So I think you just need to run the numbers and say, hey, one is my valuation. Does it make sense? Because really what private equity is doing is they're pulling forward 3 to 5 years of your income and paying that to you today.
Yeah, and knowing they're going to get it back.
Knowing they're going to get it back, right? So I think everyone needs to do that analysis in their head. And oftentimes selling to private equity makes a lot more sense financially if the valuation is right.
What happens, I do a deal, take private equity, we close, and 6 months later, I happen to get in a car accident and pass away. What happens to my stock? Does one need to negotiate up front what happens and what goes to my estate? Like how does that get worked out?
Sure. So as part of the transaction documents, they're going to have that stock memorialized in a big securities agreement. And in that securities agreement, there's provisions for what happens in the event of death, disability, etc. And generally, that stock is passed down to your estate upon any one of those situations happening. So let's just say you're incapacitated. But yes, that's sort of general market knowledge. Like, hey, nobody can control if something bad happens or you pass away or you're disabled.
But will they hold the stock for the remaining period of time, or will there be a liquidity event for that?
It'll be held for it typically will be held in your estate
for the exit length of strategy.
That is correct. Now, if some people don't want to do that, there's always the ability to have a conversation, have the stock bought back at fair market value. And so that conversation can happen. I've seen in the event of unfortunate situations with private equity groups saying, hey, we understand, let us just buy your stock back, and you may need the money now or whatever, and the wife or surviving spouse.
I mean, sometimes depending on the group, you get more down the road. But
you could, yeah.
Do you ever put something in place like buy-sell agreements at that point, or is that mute because the PE firm now has a majority stake in there?
So typically that's a mute term, right?
Okay.
Because it's the agreement's been done, and buy-sell agreements are typically done between business owners.
Yeah.
But once private equity gets involved, that typically doesn't happen at that point.
Okay. What are some of the pitfalls that you've seen? So deals meant to go well and starts off really well, and then something happens. We don't really need to get into the what, right? It could be health-related things, or some event occurs that the deal isn't going as planned. Like what are some of the pitfalls that you've seen?
Yeah, I think having a private equity group that's not financially disciplined, right? I think I've seen everyone can just Google, bankruptcies in private equity, and you'll find an article, right? So is there risk with stock? Absolutely. Is there risk in the stock market? Absolutely.
I wasn't even thinking about the PE firm. I was thinking more like the person who did the buyout wasn't performing or doing what they're supposed to be doing. But that's a good point. So the PE firm might actually not have the financial backing to carry on, right?
Right. So, there's instances where there can be fault at a couple different places, right? So it can be fault at the business owner, right? But typically what they do is they do safeguards and say, hey, we want you to make sure, every business is different, right? We're trying to maintain as close as possible to historical levels of revenue production. So they don't want you to go take a 6-month vacation after they pay you $7 million, right? They don't want you to go sit in Aruba on the beach. So they're going to say, listen, maintain your vacations as you've been doing historically. Let's keep at it together. Let's not change everything overnight.
Yeah.
But there is risk with the private equity group, right? So it can be proprietor, because if let's say you have a dentist who's the main producer and he stops producing, well, then they can be at risk, right? So there's safeguards that they prevent to do that. And typically what we've seen is forfeiture of stock. So if somebody stops performing, you lose stock. And that happens over a period of a year or 2 years or 3 years.
But it's pretty outlined, right?
Oh yeah,
so,
it's
so
very much outlined.
You get in that situation, it's because you allowed yourself, like you knew the rules of engagement, right? So it's
Absolutely.
like you wake up one day, you're like, it doesn't matter to me anymore, and I got my 7 million, and so I'm cool with getting another 1.5 million. I'm out. I want to go to Maui for 6 months.
Yes, exactly.
And not follow suit.
Yeah, and most of the deals, what we're seeing, actually, I just finished a close a deal last month, and now we're seeing, especially in the healthcare world, groups saying, we want you to maintain 85% of your historical productivity for doctors, right? Which is new. We actually haven't seen that in the last 5 years. It's really a new phenomenon that's sort of come up today.
So in your experience, most people 5 years exit, or they end up wanting to stick around, or they end up leaving sooner?
So we've seen group people stick around for 5 years and longer. It just depends, I guess, how the business is going post-closing, right? Are they happy with the private equity group? I check in with all my clients. I checked in recently and with one of my doctors who I did my first deals. And he's like, this is one of the best decisions I ever made. He goes, I was ready to retire and I needed them to help me hire a doctor to replace me over time. And he's like, it's the best decision I ever made. So it's
getting
fantastic.
to do what he enjoys without worrying about the stress of the business.
And he doesn't have to worry about it. Exactly. So I think it just depends, and going back to as long as the operator is a good operator, then that's an important thing. And I think as you're doing your conversation private equity, make sure you have reference calls. Talk to other guys that are with the private equity group. I always tell my clients,
if I'm a doctor, I'd want to get a list of other doctors,
yes,
like the operators that I can talk to and say, hey, what's the good, bad, ugly, and indifferent?
Exactly. So I typically say is get 3 reference calls. Find a guy who was the most recent to join and ask him how his experience is. Find a guy who joined a year ago, and then find somebody who joined 2 years ago. And then you'll get a perfect sort of mix of what's the real story.
You'll get the onboarding,
right? The transition, and everything. So I think that's sort of the right way. And if somebody's not going to provide you 3 references, run. Yeah. I think it's critical to have references because those people are on the other side of the curtain. So
and that's a red flag too, right?
Yeah.
So if I'm vetting you out and you're short and snappy with me, and it seems like I'm bothering you every time, and
yeah, exactly,
that's probably a red flag that you're
yes,
not going to be a good collaborator with me.
That's right.
In the deal, does it specify hey, 5-7 years I have to be out, or is that kind of open? Because I thought, when you did PE, you scaled, but you scaled with an exit point of view down the road.
So typically they do scale with an exit, but a lot of the contracts are written so that they auto renew, right? So it's really at the discretion of either party, right? Because let's face it, there is risk, and nobody knows how the relationship's going to be, but if either party doesn't want to renew, they typically have to give a 6 months notice period, right? Saying, hey, it's been a great 5 years, but we're not going to renew your contract. And it can go vice versa. So I think either way, but I think first 5 years you work together, and I think giving that notice period is pretty fair to either side.
So I know you know this. I've bought 5 practices. I've bought 5 other financial advisor practices out, and it was private equity. There was no PE involved. But one of the toughest decisions that business owner who was selling to me had to deal with was exiting, right? So perfect deal, perfect conditions, kumbaya, everything's great, everything's going well. It's a final day, we're signing documents, and it's like, wait, I don't know if I want to retire. I don't know if I want to do this, you know? Because tomorrow morning when I wake up, I'm used to going to work. And now I'm not going to. Some kind of variation of I'm losing control.
Yes.
Right? And so there tends to be a little seller's remorse and a little bit of lost of what happens next. Mm-hmm. So I know you probably have experience with that yourself as you're smiling. So, what are some of the things that, in terms of mental preparation, should a business owner be thinking about and make sure they have in place? Maybe some people who have had that in place that had a really good transition versus someone who didn't. How could they prepare for that transition to make sure that they're in a good spot with it?
I would say they should that process. It's a very emotional process, right? This is your baby. I think once a bulk of the due diligence is done and the deal is solid, right? So they're going to look at your financial due diligence general. I think at that point, conversations need to start happening about what's life look like from an integration perspective and post closing, and then have some really honest conversations, right? So that this seller's remorse doesn't happen at the 11th hour, right? Because to me, if it happens at the 11th hour, the buyer hasn't had enough conversations about what life is going to be like, right? And having clear expectations on both sides helps both parties get their head around, hey, what is this life going to look like going forward, right? So I think it's important on the buyer side to really get those conversations going and set clear expectations so that they have time to process, right? Because that waking up the next day not having it, maybe there wasn't enough conversation. Not that saying it was you or anybody, but it can happen to anybody, right? But it's just
it's a big, it's like you're out in the middle of the ocean and you're jumping off the boat, right?
Yeah.
And you just, it's a big unknown. It's a big void that you have to fill.
Sure.
And I know when I'm talking to a client about retiring, we're always talking about what the next 6 months to a year and a half to 3 years looks like, and helping them put things in place in terms of like basically goal setting, right?
That's right.
On the personal side, goal setting to help them fill up, to just kind of think through what that might look like, so it's not a shock, because I think some people underestimate it until it actually happens.
Oh, I think it's 100%. And I think just having those conversations like, hey, also, what is my transition going to be? Is it 3 months? Is it 6 months? Is it a year? Like, what do you really want? I mean, I think that just allows people to wrap their heads around and really plan for themselves what post deal looks like.
So, one more, I just wanted to tie up the advisor thing. So I'd be looking for, and if I were looking for someone to look at my deal in conjunction with negotiating with you, the PE firm, I'd want that person to be an investment banker. Who would it, what's the professional title of that particular person that I'd want as my advisor in my corner?
Yeah, so I would say the title for that person is either a business broker or an investment banker.
Okay.
Now, people always ask me, what's the difference between those? I think investment bankers are a slightly higher pedigree in terms of their level of sophistication and amount of transactions they've been dealing with, and how they package and present information. Okay. I've dealt with business brokers throughout my career, and business brokers aren't always the most professional, don't have a well put together plan. There are some that are very great, but I will say,
because the majority of them are just selling the business with not thinking through what that 30% of stock that you're getting rollover might actually do for you. They're transactional, like we sell, we get paid lump sum, we walk away.
Correct. And the business brokers are typically dealing with business owner to business owner, right? And so when you're dealing with private equity, they're typically dealing with investment bankers who are running a process, who have developed a financial model and really can support the valuation that we're going to market with. So there's just a higher level of sophistication. So I would say speak with an investment banker, look at their track record of success and history, and speak with 2 or 3 investment banks and see who you gel the most with, right? Listen, everyone's going to have fees, right? It's cost of doing business. I don't think a decision should always be based on who has the lowest fee. I think you should look at a combination of, one, can the person who I'm looking at across table get a deal done for me? 2, have they done deals and how many deals? And number 3, have they connected me with references with people who they've done deals with, right? And I think that's critical because, again, speaking of private equity, you should have 3 conversations. You should have the same conversation with private equity, somebody who's gone through a process with who you're looking to hire on, can they get transactions done, and what was that process like?
Now, when you say investment banker, I automatically think I got to call Goldman Sachs, and then I'm like, I don't have the kind of money to,
Right.
my business is not big enough for Goldman Sachs to talk to me. So are there other investment bankers out there that are not big Wall Street firms that most people would think about?
Yes, of course there are. There's
Okay.
banks. What they're called boutique investment banks, right?
Okay.
So if you talk about investment, yes, you think Goldman Sachs, all these Morgan Stanley groups. Those guys are doing IPOs and they're dealing multi-billion-dollar transactions. So there's boutique investment banks that are around regionally, locally, that have done a lot of these transactions. So I would say focus on some of those groups and have conversations with them. Look at their deals that they've done. They should have on their website what deals have they done for business owners, right? And then when you have a conversation with them, they'll lay out, hey, what's our investment requirements? What are we looking at? And what is the cost? How does that process look like? So they'll pitch you and give you everything. So yes, so there's boutique investment banks is where I would start. And then your relative business line of specialty.
So let's say I'm a person who's really shy. I don't want to bother anyone, but this conversation has intrigued me, and I had your level of expertise and knowledge, and I went to my computer. What would be the first thing I'd put on a Google search or something if I'm me, having the knowledge that would help get me going down the conversation?
I would say Google investment banks that represent the business you own.
So investment banks,
Investment,
dentists.
Investment banks representing dentists, car wash, investment banks representing car wash,
Some
and
kind
then,
of combination of
yeah,
that nature.
absolutely. And then what you'll see is people on our side have put out a ton of articles and information, and you'll start seeing it on all your Google searches, or do Chat GPT or whatever AI function you want to use. But all that information is available out there, and then you can sort of vet it if you're a shy person, and then if you really don't want to talk to anybody, put in a form submission, and somebody will call you.
Okay, so now let's talk about your market, right?
Sure.
So thanks for taking the time to share this knowledge, and if it helps one person, it was time well spent. Let's talk about your market. You're here in South Florida. What types of practices are you guys looking for in terms of revenue or size or whatnot? If you had your perfect person who would call you after listening to this, who would it be and what would it look like?
Yeah. So one, we work nationwide with healthcare groups. Our minimums in revenues are a minimum of $3 million in revenue, and about $1 million in EBITDA, which is your profitability. We do that because the groups
explain EBITDA for those who might have EBITDA but don't really know the terminology of that.
Yeah. So EBITDA is earnings before interest, taxes, depreciation, and amortization. So basically, for a business owner, you look at your net income and you add back depreciation, taxes, and amortization. And what investment banks do is we take that EBITDA and then we create what's called an adjusted EBITDA, which is basically how would your business operate if you were not running personal expenses through it, but it was under the ownership of somebody else. So let's say you're doing $1 million in EBITDA when you go home and you look at it now, and you're running personal expenses, and there's some expenses that are not going to be there going forward. We would add those back and create an adjusted EBITDA. So now your EBITDA would be $1.5 million.
And that's before optimizing,
correct,
running it the way you'd be able to run and optimize.
That is correct. So we did some level of optimization, but not fully there.
Mm-hmm.
So that's the term EBITDA, and that's important because that's the proxy that investment banks use to evaluate the profitability of companies. Because what banks do when they loan money to businesses, they're going to look at their EBITDA. Mm-hmm. And so every group is looking at EBITDA as sort of like, what is the business earnings at the end of the day?
So $3 million, $1 million in EBITDA.
Yep.
Nationwide.
Nationwide. And we work with doctors. That could be one doctor all the way up to 15 doctor practices. So we're fine. So we've covered businesses.
What type of doctor? Primary cares?
Anything healthcare related, right?
So plastic surgeons,
dentists, med spa owners. We got cardiologists, vascular surgeons, orthopedic doctors.
So healthcare.
Healthcare.
If you're in the healthcare business, then and you're looking for a PE
That's right.
nationwide with $1 million in EBITDA,
Million in EBITDA.
that's a conversation that they can start with you.
Yeah, and I always tell you when I have my first conversations with prospective clients is, we typically have two boxes of people we deal with. We deal with the guy who's looking for an exit strategy. Hey, I'm going to retire in the next 5 to 7 years. Can you help me figure out what does that look like? And the other box is, hey, I'm 45, but I want to grow my business to 5 locations, but I need capital. I can't just go out and get loans. How do I just juice this business? So people are typically, it's like sort of like a Venn diagram or somewhere in between.
Mm-hmm.
And so that's sort of who we typically deal with from a client perspective.
Okay. And in the podcast episode, we'll put your information down there. So if anyone wants to reach out, they're certainly welcome to reach out.
Absolutely.
And what I do, just so you know, what I do very well that complements what you're doing, which you already know this, but I take a look at the personal financial planning side of it, right? So we take a look at that $7 million in our example coming in after taxes. What do we have to plan for the future? And then we also look at that $3 million. So a lot of times I'm able to help the business owner decide what the numbers need to be, in terms of like, this would be a very nice number. Mm-hmm. This is a minimum number you want to shoot for, so that as they're negotiating, they actually have an idea of how that's going to translate from the business over to their personal. So it's always a fun adventure, and it's always fun and to go through those types of analytics and help be part of the conversation. But as we conclude, anything you can think of we didn't cover, anything that you would want them to know that's like, yeah, we probably should hit them with that detail?
Yeah, I would say get started sooner than later, right? Because most business owners who are successful have built fantastic businesses, but they've built very expensive businesses, and finding the right buyer takes time. So don't be hesitant to get the conversation going, and don't wait till you're 60 or 65, right? I get a lot of calls from people who are saying, hey, I want to sell my business and I want to be done by December this year. Well, it doesn't work like that, right? So especially in healthcare.
It could, but you're probably not going to get as much money.
You're not going to maximize your valuation, right? So I think for any business owner is the sooner you get started, you're able to maximize your valuation and find the right buyer, because it could take some time. And so that's where I would just leave people is working with people like yourself to plan about where you need to be for retirement can really help set the stage for your exit.
I've always found working with business owners, they're young, they work extremely hard to build a business, and they do it because they want the financial independence that they think the business is going to give them, right? Mm-hmm. They spend all this time in the business, they put all the money back in the business grows. Yep. And then when it comes time to exit, there's a part of them that doesn't feel it's worth as much. Yeah. Or it's not worth doing, PE, or it's not like, I can't do this, I can't scale this. Yeah. So for that mentality, then they do it, and it's like the best thing they ever did. They can't believe that they didn't do it sooner, or thankfully that they did it. What would you say to the mindset in terms of, like, as you're getting to that point, a good mindset that they can kind of emulate that would help them with that push?
I would say is what does life look like for this business and my family, right? I think doing some introspective soul searching, right? You've spent all this time building a business, and you did it for you and your family at the end of the day, right? So there should be a nice way to cash out on that and have a financial reward.
And there's nothing wrong with that.
And there's nothing wrong with that, right? And I think some people have family that come to work in the business. I have doctors say, hey, my son's going to come in and I want this business to go to him. And I said, listen, that's fine. You can do that. But you've built a monster business. You should get paid for it, right? And your son may not want to run the business. So I think it's just sort of having those introspective discussions with yourself and reflections and saying, what does my life look like, right? I worked 20, 30 years and spent those late nights or took those phone calls, and you should be rewarded for that. And I think to get rewarded via financial, having selling your business is a really good way to do that.
Yeah. So in closing point, I think a good closing point would be like, you've worked hard, you deserve it. Cash in on it.
Cash in on it. Absolutely.
Cash in on it.
Absolutely. Because there's nothing more that you deserve as a business owner, having done that. And I see it with people. People get trapped and they make bad decisions, and the business owns them, and then they can't sell. And then the worst thing is to give just the keys back to the landlord and to get nothing for all that work.
Well, it's the health, right?
Right.
You extend it thinking, one day, and then your health, because you've spent so much time in the business,
That's right.
You didn't take care of yourself, and then you get to a point where it's not worth as much because you haven't been able to operate it the way that you did when you were firing all cylinders.
You got it. And so I think you nailed it. And I think hopefully this conversation was insightful to any business owners, and it's just educate yourself as you get through the process. So there's a huge opportunity out there for business owners today.
So that's what this channel is about. It's about helping business owners get an inside look on some of the other conversations that they might not, be able to do day to day because they're out there doing their things. So thank you for coming in.
Thank you for having me, John.
Appreciate the friendship over the last 10 years or so.
Absolutely. I think it's longer than that, though.
I think so, yeah. I was trying not to age ourselves.
Well, thank you for having me, John. This was great.
Okay, thank you.
Thank you.
Bye-bye.